Good morning, team. Today I'm leading this session on how we use sensitivity analysis to improve capital budgeting decisions. Imagine we are about to take on a new major project. The forecast looks great, the net present value is positive, and everyone is excited. But in the back of our minds, there is always a hesitation. What if something goes wrong? What if sales decline 10%? What if the material costs spike? Today we're going to learn how to answer those questions with a powerful tool: sensitivity analysis. We'll cover what it is, how to use it, and how it ultimately protects our financial stability and leads to smarter investments. Let's jump in. The goal of financial management is simple: maximize shareholders' wealth. That means we don't just chase profits, we pursue value while managing risk. Companies don't have unlimited capital, so according to Irons, managers must plan how they are going to invest money to grow their business. That means balancing growth opportunities with risk. It's like long-term retirement investing. You don't just chase high returns, you evaluate risk and sustainability. Capital budgeting tools help us measure value, but understanding risk is what makes those tools truly powerful. And here's where sensitivity analysis plays a vital role as a tool to evaluate that uncertainty before committing the firm's capital. Sensitivity analysis is basically a what-if tool. Sensitivity analysis answers one powerful question: what happens if our assumptions are wrong? For example, what if sales are lower than expected? What if costs rise? Instead of changing everything at once, we isolate one variable and observe how the net present value responds. By shifting the input assumption, decision makers can determine how sensitive certain measures are to changes in that assumption. It doesn't tell us the probability of something happening, it simply shows which factor have the biggest impact on value. The process starts with our base case net present value, NPV, our original forecast, right? Then we identify measurable inputs with the most uncertain variables, like sales, like price, cost, or even the discount rate. We adjust one input at a time, maybe plus or minus 10 or 20%, and calculate the new net present value. The variable that causes the largest swing in net present value is our biggest risk driver. A tornado diagram visually ranks these risks from most impactful at the top to least impactful at the bottom, making it easier for our leadership to quickly understand where attention is needed. Not all risks come in the form of numbers. Competitive pressure, regulations, political instability, or leadership changes can significantly affect a project's outcome. These qualitative factors eventually influence quantitative inputs like sales, forecast, or cost. Strong financial managers don't just look at spreadsheets, they must understand the broader environment that shapes those numbers. Sensitivity analysis is one of several internal tools used to evaluate risk. The expected monetary value, EMV, assigns probabilities to outcomes and calculates expected value using projected cash flows. Scenario analysis looks at best, base, and worst cases by changing multiple variables at once. The break-even analysis tells us the minimum performance required to avoid losses. The stress testing pushes assumptions to extreme levels to evaluate resilience. And these tools help managers move beyond simple profitability and think strategically about uncertainty. In my opinion, sensitivity analysis is often the starting point because it's clear, it's visual, and easy to communicate. However, it assumes that variables move independently, which isn't always true. Risk isn't just internal. Usually, capital markets also influence how we evaluate projects. The weighted average cost of capital reflects the return investors require based on risk. Credit spreads and industry benchmarks provide additional signals about financial health and expectations. Just like in personal investing, higher perceived risk demands higher expected returns. These external measures ensure we evaluate projects within real-world market conditions. To wrap this up, let's be realistic. We can eliminate risk. No one can predict what will happen in the future. That's why it is important to understand the economic characteristics of a project and the implications of being wrong. Sensitivity analysis doesn't eliminate uncertainty, but it makes it visible. It helps leaders understand which assumptions matter most and where a project is vulnerable. That transparency improves budgeting accuracy and strategic planning. Whether we are managing corporate investments or planning long-term retirement portfolios, understanding sensitivity to change is essential for protecting value. Ultimately, better awareness of risk leads to better financial decisions. That concludes this training. I hope you learned something today from it.